And so Coolwater helps these investors ideate, figure out what and why they're actually raising a fund. It helps them launch. It helps them understand what the job is of being a fund manager, right? You're running the back office, you're managing a team, you're investing, you're sitting on your own investment committee, you're figuring out how to strategically position and scale your firm over time, right? Like these are different roles that you need to embody and master if you're going to be a great fund manager.
Hi, Winter. Thank you so much for being here. How are you?
Great, Kiori-san. Thank you so much for having me.
Yes, the reason why I wanted to interview you was our common friend, Yusuke Kaga from Jetro. He really recommended me to interview you. So I'm happy to listen your story.
Very excited to share. Thank you, Yusuke-san.
Yes. So, Winter, so could you please tell us about yourself? What do you do in the US and also Japan?
Great. So hello, everyone. It's great to be on the pod today. I'll start off by explaining what we do in the US that was founded in Silicon Valley, and then what we're doing in Japan. So my background, just very high level, is coming from the institutional allocator world. That means I'm an investor and I've invested into private equity and venture capital. About 10 years ago, I started to focus more on investing into venture capital. I've helped build a couple of fund of funds and invest those funds into emerging managers and established managers. And I've also launched Coolwater Capital, which is an incubator and accelerator for funds. So if you're familiar with other prominent accelerator models like Y Combinator or Techstars or 500 Global or Antler, these are, if you're in the venture capital space, these are household names of accelerators for startups. So their focus is helping founders. Their focus is investing into founders. Their focus is raising funds to invest into what they believe are the best teams, building the next generation best companies. Coolwater does that, but we do it for investors. So these are founders, but they're founders of investment firms. They're raising investment funds. And so Coolwater helps these investors ideate, figure out what and why they're actually raising a fund. It helps them launch, right? Put the pieces in place, lay the foundation, build the back office, build the front office. It helps them understand what the job is of being a fund manager, right? You're running the back office, you're managing a team, you're investing, you're sitting on your own investment committee, you're figuring out how to strategically position and scale your firm over time, right? Like these are different roles that you need to embody and master if you're going to be a great fund manager. And so, yeah, Coolwater runs an incubator accelerator to help investors become fund managers. And we run multiple programs. And in the US, we have run now close to 20 cohorts. And last year, we actually expanded to Tokyo, to Japan, in partnership with Jetro. So excited to share more about that on the pod today.
Thank you so much. So why did you come up with this idea? It's so unique to help the investor to become a fund manager.
Yeah, thank you for the question. The idea, I started to gain traction with the idea in 2016. That's when I first started writing about it. I look back, I've written 2 books, how to raise a venture capital fund and how to set up a venture capital fund. So as I was looking back on notes, kind of writing the first and second book, I noticed that's when I really started to put together thoughts and ideas around, what does it mean to build an investment firm? I think if you're sitting at an existing investment firm, you're not necessarily thinking about building the firm. if you're an operator or founder building a technology company, you might be really great at building a technology company, but you're not thinking about how to build an investment firm. And if you're an LP and an allocator, right, like you're good at underwriting fund investments or other types of investments. But again, like you're not in the trenches day to day working with these managers, helping them think through, again, like ideation, inception, launch, how do you build these different business processes? How do you build and scale and change across fund 1 to fund 2 to fund 3? So as I started thinking about it, again, in the mid 2010s, there was this idea of like a gap in the market, that something was fundamentally missing. And again, I was in an institutional allocator limited partner role. And we were large enough where we had to focus on bigger fund opportunities. So most of the capital we were allocating was into $100 to $500 million funds. So not super big funds, but not super small funds either. And when I looked at the performance data, and this is a key point, right? So like why spend time with smaller funds? Why spend time on anything, but why spend time on smaller funds? What I noticed with the performance data, and this is, backed by decades of research, that smaller funds, outperformed. But it wasn't just a testament to smaller funds. It was the talent behind those funds. It was the investors. It was their experience. It was their skill set. It was their embracing, right, this idea that I had to build a fund and a firm to be successful. But I noticed it was very hard to do that. And small funds don't have a lot of fees, right? They don't have a landing pad, or they didn't have a landing pad like Coolwater to really help them understand, again, these fund management concepts, to understand what it meant to build an investment firm, to evolve as an investment firm. And so it did feel like there was this gap in the market. And so it came together over a number of years, right? Think of it as like a 5-year overnight success story. So started iterating on it in 2016, but started, talking with more firms about it, started observing what was in the market, what are other models that seem to do really well, right? Someone like Y Combinator has a great brand and reputation, kind of redefined what it meant to be as a venture capital firm, 20 years ago. And so you could start to look at these other models and say, okay, well, if I'm going to build something, how do I build it so it's different? And how do I build it so it's better? And so I think, that was a long iterative process over 5 years, trying to figure out the best model. We haven't fully figured it out yet. We're still building and we're still iterating and we're still hungry to help emerging managers. But I think it was that confluence of different factors, being an LP, understanding the landscape, having the privilege to talk to hundreds of emerging managers every year, really understanding what the gap was from a first principles level, from like actually doing the job and kind of noticing what the pain point was. And then, starting to work with emerging managers over a couple of year period. I acted for 3 years as like a COO, CFO, kind of early partner, early advisor to a number of different funds before even launching this concept of Accelerator for funds. And so the reason I did that was, when you come from the LP background, you have a skill set as an investor, and you can be very good at underwriting funds or maybe underwriting companies. But to actually build an investment firm is different than underwriting an investment firm as an investment. And so I spent a number of years, again, working very closely with a number of founder GPs, again, venture capitalists that are founders of their own firms. I spent a number of years working with them, coaching them, identifying what their pain points were. And again, it's this kind of confluence of things, this amalgamation of these different experiences, right, that I kind of turned into a systematic platform and program to deliver value to emerging managers. And again, the reason behind it is not only to help emerging managers, but I strongly believe emerging managers are a great investment bet. And I'm coming from the investment background. And so I'm working with people that I think are going to make LPs, great returns.
Thank you so much, Winter. It's so fascinating because you found a pain point. It's a market gap. It's amazing. That's why you started to your Coolwater Capital. So, do you have your co-founder?
We do not have we have a team of 13 people right now. We have a co-founder in the Japan program. So yes, there's a co-founder in Japan that helped us identify the market opportunity there, identify the right stakeholders, and launch that program, if that's what your question is.
Thank you so much. And since you started your cohort program, what was the difficult part or biggest challenge?
For developing the program?
Yes.
I mean, if there's founders in the audience, the biggest challenge is always just building a business, right? There's 100 things, 1,000 things to manage. I think the biggest challenge, if I'm taking a step back from like the day-to-day in the weeds challenges, I think the biggest challenge is one, building something new that other people don't think can exist, right? I think that's really hard. If you've been there and done that and kind of willed into existence something that hasn't existed before, we've pioneered this model of accelerator for funds. The concept existed. We didn't invent the concept of accelerator. There were other people helping funds. There were founder GPs investing into other founder GPs. There were fund of funds that existed before us. There were accelerators for startups. So I don't think we invented the concept. We didn't invent the concept, but we had to put a bunch of pieces in place and figure out how this could actually work, be systematic, and be scalable. So that I think was one challenge that was, like I mentioned, 5-year overnight success. It was immensely iterative, and you never have all the answers. You're just trying to, figure it out as you go. In some cases, we have skill sets, we have ambition, we have, excitement, like we have the willingness to do it. But, when you're building a product for the first time, to make it impactful and to make it scalable, I think that was like one of the major challenges. And I think the other major challenge, and this is true both in the US and for the Japanese cohort, is getting people excited about smaller funds, right? Especially institutionally. So I think the way a lot of the early stage market works is there's concentric circles, like there's what's called the friends and family, right? And so I think there's a lot of very successful people that can continue to be successful because they have great friends and family, meaning high net worths, connections to capital network, right? Like in this context, a fund manager is able to launch a fund because they have wealthy friends and family, right? And I think at some point you run out of friends and family, meaning you might raise, in terms of US dollars, like 10 million or 25 million or 50 million. And that kind of sounds crazy to say it out loud, like you run out of $50 million of friends and family capital. But what I mean by that is you've kind of exhausted all of your relationships that you've built your career on to date. You've raised capital, and now you're trying to get to the next stage, right? So let's say you've raised 50 million across 2 or 3 funds. That's called your assets under management. So maybe you start with a $5 million fund, and then you raise a, $20 million fund, and then you raise a $25 million fund. So you have $50 million of assets under management because you're totaling the fund sizes across those 3 funds. You still may have illiquidity, right? Some of those early LPs in Fund 1, Fund 2, Fund 3 that backed you because they're friends and family might be out of cash to invest into your Fund 4. But there's enough data at that point, usually after Fund 2 or Fund 3, where other people might actually see you being good at executing, having a great strategy. You've been able to identify and invest into great companies. The portfolio metrics, so meaning like your fund on a cash on cash basis in terms of value, might be great, especially for Fund 1 and Fund 2. So you might be seeing like all these signals that point to you're a great investor, this is a great next generation firm. But when you get to that fund 3 or fund 4, you kind of run out of room to scale and have relationships with institutions and kind of get to the next step, right? And I think that's a big challenge is educating GPs on what that next step means, but also educating LPs on the investment opportunity in small funds and how to understand kind of the signals behind great traction in an early fund franchise and invest, potentially a fund cycle earlier, right? And that's a big mission behind Coolwater is trying to bring more corporates, trying to bring more LPs, trying to bring more family offices into this realm of emerging managers and smaller funds and really understand the different variables they should be assessing so that they can make smart investment decisions themselves and invest into great firms and make really strong decisions themselves, right? What we don't want is to have LPs invest into the space and then lose their shirt. That's not they're not going to continue to invest in the venture. They're not going to continue to invest in small funds. So we want people to go in, LPs in particular, eyes wide open into this world. And I think that's a big challenge right now where some LPs are reluctant to 1, invest into alternatives, to 2, invest into venture, to 3, spend the time and the resources to understand the small fund space and identify great small fund investments. So I think that's the second kind of big challenge is, a lot of the capital that could be unlocked for this space is still relatively unlocked.
The 3 key takeaways from a conversation with Winter, Part 1. 1. VCs need accelerators too, not just startups. Winter identified a big gap. There were plenty of accelerators for startup founders, but none for fund managers who are building their own venture firms. So, he created Coolwater Capital, an accelerator that helps emerging investors go from idea to full-scale fund operations. Example, just like Y Combinator helps startup founders, Coolwater helps fund founders learn how to structure their firm, raise capital, manage operations, and grow from Fund 1 to Fund 3 and beyond. 2. Small funds can outperform but lack support. Smaller VC funds often outperform large ones, especially in early stages, but they rarely get institutional backing or proper guidance to grow. Winter saw this firsthand as a former LP and realized emerging managers needed hands-on help to scale. Example, a new fund manager might raise a $5 million, $20 million, and $25 million fund from a personal network, but eventually hits a wall. Coolwater steps in to help them break through to institutional investors, guiding them through the Fund IV plateau. 3. Building something new, educating the market. One of Winter's hardest challenges was building something that didn't exist before, an accelerator for funds. It took years of iterations, education, and convincing both fund managers and LPs that this model could work. Example, just like early LPs were skeptical of Y Combinator style startup accelerators, Winter had to convince investors that structured, scalable support for fund managers was not only possible, but necessary to unlock new capital and long-term returns. Okay, thank you so much for watching our episode today. We hope today's conversation will help your future and career. If you like it, please subscribe us and give you a like. The next episode is the conversation with Winter Part 2. Please stay tuned. Okay, bye bye. またね。チャオ。